Welcome and thank you for joining us. I am George Anthony Long, the chair of the Space Law Committee for the ABA Science and Technology section. It has been a distinct privilege to collaborate with Professor Annette Nellen, of the ABA's tax section to put together this webinar on legal and policy issues surrounding the taxation of space activities. The time has now arrived to give our attention and focus to Annette and our distinguished panel members.
Thank you, George. And thank you to the ABA Science and Technology section and the Taxation section for co-sponsoring this free webinar today. And thanks to George, chair of the Space Law Committee of the Science and Technology section. I'm Annette Nellen, a tax professor at San Jose State University, and I actually chair the ABA Tax Section's Tax Policy and Simplification Committee, and I'm actually a longtime member of the Science and Technology section as well. Been fascinated by space activity since I was a young child and look for any opportunity to delve into these topics, which are of growing importance to all of us today. And thanks to George for encouraging and directing this coordination of space law and tax considerations here as well. Thank to all of you for your interest in this topic and learning more about where tax and space activities do intersect. And we'll go through, I think, a good introduction to both understanding some of the space issues, but I think it also gain an appreciation of just a variety of tax issues and tax knowledge here. I'm very pleased that for outstanding panel here. We have Erica Isabella Scuderi, assistant professor at the Levin College of Law at the University of Florida. She has studied in Italy, Vienna, and the US, and in addition to a law degree, earned a doctorate degree at the Vienna University of Economics and Business, with her dissertation focused on space taxation, and she continues to engage in scholarship in this area. And thank you for preparing the slides we'll see today. We also have Jonathan Galen, an attorney advisor at the U.S. Treasury Department, and his areas include international provisions, including work on aspects of Section 863 of the Internal Revenue Code and Reg 1.863-8 that involve the jurisdictional and sourcing issues of taxing space and something somewhat related, ocean activities. Also, Delinda Tamagani is the director of Multi-State Tax Bureau of the California Franchise Tax Board, or FTB. She is involved with a reg drafted in 2017 on apportionment and allocation of income of space transportation companies, where we'll learn that 62 statute miles above the Earth is relevant, and we'll learn more about that today. I do want to greatly appreciate Jonathan, Delinda, joining us today. They are speaking on behalf of themselves, not unless they're representing a government view here. Well, let's get into understanding appreciation of tax rules and issues for space activities with Professor Erica Scuderi. And we'll leave time at the end for questions, but you also can be typing those questions or comments into the Q&A or to the chat box. Thank you very much. Erica?
Thanks so much, Annette, for your kind introduction. And thank you, everyone, for joining us today. I am really excited to talk about this topic. I have been dealing with space taxation for the past 6 years. And our presentation today will put together basic elements of tax law as they interact with space law, as well as basic elements of space law for the tax lawyers in the room who didn't have the chance in the past to read the Outer Space Treaty. But in order for us to do that, we must start with some basic questions that probably sparked our interest in space taxation. First and foremost, what is space taxation? Why should we even care about this topic? What is a space income? Are there provisions? How is space taxation regulated right now at the federal and state level? And how can we use the tax system for objectives other than revenue objectives? For example, for space sustainability purposes. We will leave some time, as Annette mentioned, at the end for questions and concluding remarks. So stay tuned until the end if you have questions, or write them, I think, in the chat, and then we can answer from there. So first question, what is a space taxation? What do we mean by that? So clearly, space taxation is a tax law as it applies to economic activities connected to outer space. Tax law, meaning both domestic and international tax law. It does seem like a straightforward definition. However, it does raise a few questions concerning the classification of income. Is all income generated in outer space income in a sense that is relevant for the Internal Revenue Code? Where is space income sourced? So this raises questions about territoriality, sovereignty in space. In a minute, we will delve into this specific topic, and strictly connected to territoriality, again, what's the source of space income for tax purposes? For forward-looking question may be, what's the source of resource extraction, so space mining income? And are there tax incentives in place? Can space companies benefit from existing tax incentives, or are there space-specific tax incentives? So let's start with the very basic questions about sovereignty and territoriality. And in order to do that, we need to take a step back. And I will take you back in time to 1944, when the Chicago Convention was signed. It later entered into effect in 1947. At the time, all the contracting states agreed that they have complete and exclusive sovereignty over the airspace above their territories. However, the Chicago Convention did not define the term airspace, and therefore, at least in the at the international level, we do not have an internationally agreed upon definition of airspace. What we know is that all contracting states, so all members of the Chicago Convention, which is the Convention on International Civil Aviation, they do keep complete and exclusive sovereignty, which means also from a tax perspective, the most ample jurisdiction to tax. What happens in outer space then? So in 1967, the Outer Space Treaty was signed and ratified, and its Article 2, it reads that outer space, including the moon and other celestial bodies, is not subject to national appropriation by claim of sovereignty, by means of use or occupation, or by any other means. As you can see, there is a striking difference between the legal regime of the airspace and that of the outer space, but also in this case, the term outer space is not defined. So we do know that in the airspace above a country's territory, that country has complete and exclusive sovereignty, but we don't know exactly, or at least at the international level, that is not defined, where airspace ends and outer space begins. Do not worry about that, because at least certain countries do have a definition, a delimitation theory in their domestic law. However, these delimitations may differ. Sometimes it's 50 miles, other times in other domestic legislation is 80 miles. At the United Nations Office for Outer Space Affairs, they are trying to push for an agreement on 100 kilometers as the delimitation between airspace and outer space. But at least in the past 30 years, during discussions and negotiations, this delimitation theory has not been included in any treaty. So why is all this important for tax lawyers? Let me jump into the next slide here. What are the tax consequences? And here, allow me to provide a brief recap of the traditional fiscal attachments needed to exercise tax jurisdiction for those space lawyers or public international lawyers who decided not to continue their career in tax. So traditionally, countries use two main fiscal attachments to exercise tax jurisdiction. One of them is the territorial attachment. It stems from territorial sovereignty over the territory of the country itself. It means that the government can exercise tax jurisdiction over any income source within the boundary of the state, regardless of who the taxpayer is. The second fiscal attachment is a personal attachment that stems from personal jurisdiction of the state, which means that every national and every resident, tax resident of the state will be taxed regardless of where income is sourced on a personal basis. So whenever there is an attachment to the individual, to the entity, so whenever the tax jurisdiction is exercised on a personal basis, the power to tax can also be divided between a territorial tax system or a worldwide tax system. I will give a couple of examples in a second about that, but it is important to remember that even when we have personal tax jurisdiction and we tax nationals or tax residents, it doesn't necessarily mean that the government will tax the worldwide income of the taxpayer. Moving a step forward, whenever income is sourced not in the territory of the state, but for example, on board ships or aircraft, a supplemental jurisdictional power enters into play, which is called the quasi-territorial jurisdiction of a functional nature, and allows generally the flag state to exercise tax jurisdiction. And this is way more complicated than how I am describing it. This is a simplification of a very complicated body of laws and rules. The basic ideas is that at least when, for example, a vessel is in international waters where there is no territorial jurisdiction of any other state, the flag state can apply its domestic laws, including tax laws. Of course, as soon as they enter into the territorial waters of another state, things might change, but let's not go too deep into that topic today. So just the brief recap, the three main fiscal attachments here are territorial, personal, and functional. In space, we clearly lose the territorial tax jurisdiction because of Article 2 of the Outer Space Treaty, which we read a few minutes ago, which says that outer space, including the moon and other celestial bodies, is not subject to territorial appropriation by claim of sovereignty or any other claims. So we lose the territoriality principle there. However, countries can retain tax jurisdiction, so the power to tax income of their nationals and their tax residents. And again, I will give you a few examples of how this can play out. And it is not included in this slide, but I have recently published an article where I suggest that the Outer Space Treaty, in particular Article 8 of the Outer Space Treaty, allows us to adopt a new principle for tax jurisdiction in space, which I termed the tax jurisdiction by registration principle. It works in a similar way as the quasi-territorial jurisdiction you see at the bottom of this slide. I published the article in the Nebraska Law Review. If you are interested in hearing more about how this principle would work, I'm happy to answer all your questions later. So I promised a few examples, and I'm going to give you 3 examples here today, just to kind of understand a little bit better why this all matters. Again, we said that in outer space, we do not have territorial sovereignty, and we have our taxpayer conducting space activities. So income does not have a source in space because of the absence of territorial sovereignty. If our taxpayer is resident for tax purposes in Italy And I'm using Italy as an example of any country that adopts a worldwide tax system. As I was mentioning earlier, whenever a country taxes their residents, they can tax either based on a worldwide tax system, which means that income, wherever sourced, will be attracted in the state of residence, or the resident or national can be taxed in the resident state only on income sourced within the territory of the state, which reminds us of the territoriality principle, but that may happen. So this first example concerns a resident state that taxes on the basis of a worldwide tax system, which means that our Italian tax resident will be taxed on space income. It will be attracted to the taxable base subject to tax, indeed, in Italy. So even if there is no source taxation, there will be residence-based taxation on space income. If our taxpayer is resident in a state that adopts a territorial tax system for the taxation of its tax residents, or our taxpayer is resident in a tax haven, for example, there will be no taxation at source because we do not have another country that can claim territorial sovereignty, but there will also be no taxation in the country of residence because the resident state will only tax income source within the boundary of the state. For example, France is one of those countries. The third example, it's closer to us. If our taxpayer is resident in the United States, there is a specific source rule that we will talk about this sourcing rule in a minute with our colleague Jonathan. Just the highlight would be that not only our taxpayer would be subject to tax because it's a resident of the United States, there is also a specific source rule that would deem generally income to be US source income under certain circumstances and with all the exceptions that we will see in a second. But this is one of the few cases, if not the only case, where domestic tax law includes a specific source rule for space income. We will see in a minute how this operates and what the carve-outs are. So we are talking about space taxation, and I mentioned space income many times. So what is a space income then? I think that at this point, I want to hand over to Jonathan. The only thing that I will mention is that space income is income from space activities, and Section 863 define what space activities are, and Jonathan will take us through the statutory text of Section 863 letter D and its function. So Jonathan, if you agree, I will leave the floor to you.
No, that's great. Thank you so much, Erica. And I know you'll be going through some of the particular details of these rules shortly, so I'll kind of give an overview here of what is space income. So a couple things. As Eric had mentioned, the U.S. is kind of like federal sourcing rule with respect to income from space activities. That was enacted by way of it's contained in Section 863D, and it covers both space and ocean income. And it was enacted in 1986, part of the 1986 Tax Reform Act. And the reason being, before I kind of get into how the rule works, is kind of taking a step back. What animated the decision to provide the specific sourcing rule for, let's talk about space specifically, is that there was a concern that U.S. persons could be, engaging activities that derive income from space activities, and that if these activities are in space where neither the U.S. nor other foreign countries are asserting primary taxing rights, that allowing U.S. taxpayers to take the position that income in the first instance is, say, arguably foreign source because they're analogizing to other sourcing rules that relates to, whether it be services income or lease income or royalty income, then in that instance, you would have those U.S. persons would have, if they were to say foreign source income, it would be foreign source income, but it wouldn't be relieving any double taxation because there wouldn't be a foreign jurisdiction that would be asserting tax with respect to that income. And so it would facilitate U.S. persons in cross-crediting, which means that they would have, to the extent those U.S. Persons had foreign tax credits, excess foreign tax credits, otherwise, that claiming that they have space activities income, if they were taking the position it was anything other than U.S. source income, would allow that U.S. taxpayer to avail of those excess foreign tax credits. There was perception that could potentially provide an avenue for abuse. So, as a result, in the 1986 Tax Reform Act, there's a specific rule that applies residence-based taxation, residence-based sourcing for the taxpayer. So in this instance, if it's under the statute, under 863D, if the taxpayer has space activities income and it's a U.S. person, then the default rule is that all of that space activities income is going to be treated as U.S. source. Therefore, they wouldn't be able to avail of the excess foreign tax credits to credit against the space activities income. The idea being because this income is not income that presumably is subject to foreign tax. So there are a couple questions there. One, in the statute. One is, what is space? The statute, neither the statute nor the legislative history defines the term space for the sourcing rule purpose. Instead, we have regulations that were promulgated in the 2000s, mid-2000s, that provide a fairly broad definition of space. And there they space is basically defined to include any area not within the jurisdiction of the U.S. or any foreign jurisdiction, but for purposes of determining whether it's in a U.S. jurisdiction or foreign jurisdiction, we look to from a U.S. perspective. So we apply a U.S. perspective and ask whether the U.S. would recognize whether the activity is occurring in a U.S. jurisdiction or a foreign jurisdiction. If it's not, if it's anywhere else, any other area, then it could be considered space. So it's quite broad. I think the reason why they use that definition, at least in part, is because, once again, if the income were derived from activities in a foreign, what we viewed as appropriately a foreign jurisdiction, presumably that foreign jurisdiction could assert taxing rights and assess tax on that income, and then we would want potentially to provide relief from double taxation by way of our sourcing rules. So the idea of space activities or the location of space is that it would be space is something that, where we don't have, from our perspective, we don't perceive anyone as having kind of a legitimate right to tax that income. The other thing to note about space activities income is it's effectively defined as a residual category. And what I mean by that is what's kind of illustrated on the slide, for activities that are that fit within certain other prescribed categories in Section 863, such as here as enumerated: transportation income, international communications income, or income from an activity with respect to mines, oil, gas wells, or natural deposits. If it fits within those categories, then it's not, the sourcing is not going to be governed under the space or ocean activity rule, under sourcing rule under 863D, even if the activity touches space. So it's one thing to be aware of, is it's you have to go first ask whether the activity is sourced under transportation income, international communications income, or this kind of mines, oil, gas well, or the deposits. One thing to note here is, at least with respect to a U.S. taxpayer, for U.S. taxpayers, they may be more inclined to try to source income under international communications income first, or transportation income first, if they thought there was like an overlap otherwise with space, because there's more of an avenue for them to potentially have the income as at least in part foreign source in that instance, whereas the default rule is that it's entirely U.S. source for that U.S. taxpayer based on the residence of the sourcing by the residence of taxpayer rule. And then one thing, I'm not going to step on Erica's shoes because I know she's going to get into this a little bit later, but with respect to the regulations, one other thing to note here is, although the default is at 100% would be, if it's a U.S. taxpayer, would be sourced, their income would be, if it's space or ocean activity, would be sourced to their residence, so therefore sources treated as U.S. source income. The regulations allow for kind of an exception to that, and the exception is where taxpayers are able to demonstrate that the assets or risks or functions relating to the activities where they're deriving that income are occurring in a foreign jurisdiction under our U.S. tax principles. Then in that instance, that portion attributable to those risks, assets, or functions in the foreign jurisdiction may be treated as foreign source. So with that, I'll turn it over back to Eric. I don't know, to help kind of like go through some of discussion of some of these exceptions with respect to the certain activities, as well as covering some of the regs.
Thanks so much, Jonathan, for this introduction on the exemption for certain activities. As Jonathan was mentioning, space and ocean income is a residual category. So if income falls within the scope of transportation income, income from mining activities, or international communications income, as in the relevant sense for the purposes of the IRC, then the source rule will be determined by by other provisions, and we will here look at these other provisions to understand what the delimitations between space and transportation, telecommunications, and mining income is. So with respect to space income versus transportation income. So Section 863 here reads that space and ocean activity does not include activity giving rise to transportation income as defined in Section 863C. So we go to 863 C number 3 for determining the meaning of transportation income. Under the IRC, transportation income means any income derived from or in connection with the use or hiring or leasing for use of a vessel or aircraft, or the performance of services directly related to the use of a vessel or aircraft. So here the question is, does the term aircraft include spacecraft? It is easier probably to say that the term vessel does not include a spacecraft, but we know that there are circumstances, at least nowadays, where, for example, for space tourism, where the dividing line between an aircraft and a spacecraft for space tourism purposes is thinner. So this is an open question for you and for us. I was mentioning earlier to our co-panelists that while I was putting this presentation together, I actually started writing another article exactly on this topic, on the limitation between space income, transportation income, and mining income. So you might see a publication coming out soon on this topic. Why is this important? This is not just an academic exercise, but as I was mentioning earlier, in space transportation income, so assume that you are a US person conducting or offering suborbital space tourism flights to customers, and you depart from Cape Canaveral and bring your customers to the ISS, or you land in another foreign country. If that activity is considered to be transportation income in under Section 800, in a sense relevant for the application of Section 863, letter C. So if the spacecraft you use can be considered an aircraft of Section 863, letter C, then because you depart from the United States and you land in a foreign country or in space, only 50% of your transportation income will be considered sourced in the United States. On the other hand, if the spacecraft you use is not considered an aircraft for the purposes of Section 863, letter C, then the entire transportation income will be considered sourced in the United States, because the assumption was that you are a US person, and therefore the entire transportation income, the entire amount, would be considered sourced in the United States. It doesn't necessarily mean that this is a worse outcome for the taxpayer, but in this case, you will have the foreign credit basket will not increase because your income will be deemed sourced in the United States. Again, this is an open question, and you might even write in the chat what your interpretation is, whether a spacecraft can be spacecraft is a term that can be included in the notion of aircraft here. Then the limitation between space income and communications income. The regulations define both the term communications activity and the term communications income. And clearly, communications income is income derived from communications activities, which are activities consisting of the delivery by transmission of communications or data, and the provision of capacity to transmit communication. Income may be considered derived from a communications activity, even if the taxpayer itself does not perform the communication function, but in all cases, the taxpayer derives communication income only if the income, so the taxpayer is paid to transmit and bears the risk of transmitting the communications. There are a few exceptions, so a few, I would say two important exceptions. First of all, delivery of communication other than by transmission. For example, clearly the delivery of physical packages and letters is not considered communications activity within the meaning of this section. And there is another exemption for the provision of content or any other additional service provided along with or in connection with a non-de minimis communication activity, which must be treated as a separate non-communication activity. So what why is this delimitation between space and communications income important? And I tried to summarize here all the various instances in which communication income and space income can overlap, and I tried to systematize also here in this slide. I will try to explain a little bit the various instances and the sourcing rules. So, in general, when we have a communication activity between 2 points in the United States, here you find this in the bottom left part of the slide, this is considered US communication activity, which is entirely sourced in the United States. So income from communication activities between 2 points in the United States is entirely sourced in the US, as well as communication activity between 1 point in the United States and 1 point in space or international waters. Also in this case, 100% US source. If communication activities happen between 2 points in a foreign country or US possession, or 1 point in a foreign country and 1 in a US possession, or between a foreign country and a point in space or international water, this is 100% foreign source income. I think that interesting points are the two ones that are that I'm about to explain. First of all, whenever we have communications between 2 points in space, or of course, international waters are relevant for the purposes of Section 863D because it includes space and ocean income. But if we have communications between 2 points in space, sourcing rules, the source rule that applies is the one in Section 863D. So if the taxpayer earning communication income is a US person, 863D, as Jonathan has explained to us, will be 100% source income. If the taxpayer is a foreign person, then this will be 100% foreign source. On the other hand, if we have a communication beginning in space or international water and originating in a foreign country and ending in the United States, this will be considered international communication income because it's income stemming from international communication activity, which means that if the taxpayer earning income is a US person, only 50% of that international communication income will be sourced in the United States. If the taxpayer is a foreign person, 100% of international communication income will be considered to be sourced abroad. So it will be foreign source income. And then there are certain situations where there is an undefinable communication activity. And here the regs tell us that this will be 100% source, US sourced income. So I know that this looks like a lot. I hope that this table can help us at least visualize the differences and why, as Jonathan was mentioning earlier, it is sometimes more convenient for taxpayers, it can be more convenient for taxpayers to qualify their income as international communication income if they are US persons, so that at least 50% of their income will be considered sourced abroad. Moving on, the final exception is the one for mining activities. So Section 863D 2 letter B tells us that the term space activity does not include any activity with respect to mines, oil and gas wells, or other natural deposits to the extent within the United States or any foreign country or possession of the United States as defined in Section 638. Every single word of this sentence is relevant for us if we want to understand whether space mining is included in this exception and therefore it is not space income, or whether we should consider space mining as falling within the scope of Section 863 letter D. And again, when I was thinking about this topic, I thought about what Jonathan told us, which is what's the role of Section 863 letter D. It is an umbrella provision. And so if space mining is not included in this exception in B3, then I would at least assume that it falls back within the scope of the general provision in section 863D. And so we need to understand whether space mining is included in the definition of activity with respect to mines or other natural deposit. And the first instinct is clearly looking at, okay, these are activities to the extent within the United States, first of all, or to the extent within any foreign country or possession of the United States. And the text as defined in section 638 is also important because it defines the territory of United States for the purposes of taxation of activities in the continental shelf. So it extends the territory of United States to the continental shelf for the taxation of income. My personal answer to the question, does space mining constitute an exception to the exception, is yes, which means that space mining is not excluded from the scope of space and ocean activity. It will fall within the scope of the general provision because for a number of reasons, but I would say the easier answer is that unless we will have a new rule or an explanation of the rule that says that when conducting activities in space, the spacecraft, the space object that allows the mining activity is considered territory of the United States. So unless that happens, there is no way to claim that the United States extend its territory to outer space. Here, I have also to be honest with you, because this is the answer I would give based on the Outer Space Treaty, but we cannot ignore some countries' constitutions, for example, Colombia and Ecuador, because in their constitution, they do extend the territory of the state, of the country, to at least the portion of geostationary orbit which corresponds to their territory. That's specifically included in their constitution. One question would be, would an activity, space mining activity, conducted in that area of the geostationary orbit be considered an activity conducted within a foreign country? So in the territory of a foreign country, my answer would be, in that case, from the US perspective, probably not, because the US has already declared that they do not, I would say, recognize the territorial claim in the geostationary orbit. But clearly, this is something we should look into in the future, because it will raise some interesting questions. And so even if I have been writing about space taxation for the past 6 years, I always find new venues for interesting questions, such as this one. So my interpretation of section 863D and its scope is that it does include space mining activities, and it does include space transportation activities generally. There are certain borderline cases, as we were mentioning earlier, where spacecraft can be considered also aircraft for the purposes of, for example, suborbital flights, space tourism. And I don't know if someone wants to... I can hear someone, but I don't know if someone was trying to speak. Okay. So this is just my interpretation, and I'd be very happy to hear your views, especially if you disagree with me. Write it in the chat or send me an email later. So moving forward. So this is just the text of section 863D, which is what Jonathan has already said. So I think we can skip this specific slide. And one more thing I wanted to highlight with respect to source rules is that if we have income from sales of purchased property and income from sales of produced property, source rules slightly change. The general rule for the sale of purchased property in space or international water is that that's space and ocean income within the meaning of Section 863D, except for, with the exception of the case in which the property is inventory property and is sold for use, consumption, or disposition outside space of international water, in which case a different sourcing rule would apply. When it comes to income from sales of produced property, here we have to distinguish two different situations. Sale of produced property where either the production or the sale takes place in space or international water is a space and ocean income if the production is 100% in space or international water. However, if the property is produced partially in space and partially outside space or international water, then the portion that is produced in space will be sourced following the rules in Section 863D, and the portion produced outside space will be sourced under the rules in Section Reg Section 863(3)(c). So there is a slightly different source rule there.
Oh,
So
I was just going to chime in, Erica. You've done a great job, I think, of walking through and explaining both kind of the elements of the regs, as well as the kind of the interaction of the 863D with the other kind of those other categories, transportation and international communication and whatnot, and raised some very interesting questions. And I just wanted to add here, because I forgot to do it earlier when I was talking, is that one, to acknowledge, at this moment, Treasury doesn't have, there's no active project right now on space or ocean sourcing rules or guidance. That said, right now, we are, seeking comments from taxpayers, tax practitioners, and whatnot in the public on topics in areas of guidance that we should take on or consider taking on for the upcoming priority guidance plan. And those we're inviting, comments up until May 29th, so 9 more days. At least that's kind of the soft deadline technically for with respect to comments with respect to this upcoming year's priority guidance plan. That said, the door is kind of always proverbially open. And so if there are other issues, if this is an area within space taxation is an area where folk think that it would be helpful to for the IRS Treasury to provide more guidance, it would be great to receive comments explaining kind of where there may be areas where more administrative guidance would be helpful, as well as an articulation of ways in which this guidance would have kind of material impacts on taxpayers or business activities, to express to what extent areas of uncertainty would if resolved would have meaningful impact on business activity. So I just wanted to kind of throw that out there. Especially given Erica, you've been doing a great job of kind of teasing up some issues. I know you're interested in receiving clarification on where possible. So just want to invite others as well that may be interested that are attending this panel to that we have an avenue for and invite any comments that they might have in terms of where there may be help or value for us at Treasury and IRS to provide administrative guidance. So just wanted to add that, and I'll give it right back to you. Thank you.
Thanks so much, Jonathan, for stressing that. It's definitely I take it as a gift that we can provide comments, and we can at least highlight some of these issues we are discussing today. So the next set of slides concerns the existing rules in federal tax provisions and state provisions. Some of them we have already mentioned, for example, Section 863D, and the question that we are discussing here would be, should tax treaties also be modified? I haven't included slides on tax treaties here, but there are a number of interesting questions concerning is space income falling within the scope of tax treaties? I actually have another article that I'm drafting on the territorial extension of tax treaties, where I analyze the geographical extension of treaties. So maybe if you're interested, you can follow on that. Other areas that are very interesting are tax incentives, tax credits, tax exemptions, and I will in a second give the floor to Annette, because she will walk us through some of the important tax incentives in this area. And user fees. As of 2026, the FAA can assess a user fee on commercial space launches and reentries, which is calculated based on the weight of the payload, and the generated income is then used to support the FAA's Office of Commercial Space Transportation. The justification for this new fee was that FAA had an increased workload because of the necessity to close the airspace during space launches, of course, to avoid accidents. And because of the increased workload, there was a necessity to expand the FAA let's say competences, and therefore this launch fee will support that. The fee is 25 cents per pound of payload in 2026, which is capped at $30,000 in 2026, and it will increase in 2033. It will be $1.50, and it will be capped at $200,000. There is a lot to say about this fee, but I would actually here hand over to Annette for a description of some tax incentives that apply at the federal level to the space sector. So Annette, the floor is yours, and I also invite you all to read her publication, Tax Relevance of Tech News Apollo 1150 Anniversary.
Yeah, thanks, Erica. You're raising a lot of issues here, and interesting, the 86 Act, Tax Reform Act of 86, celebrating its 40th anniversary this October 22nd, and wondering if perhaps it's a time for looking at what's changed in 40 years. Obviously, a lot has changed in 40 years. These rules really getting at what is going on today and what might be going on in the near future. On the tax treaty, Erica, your comment about how Colombia and Ecuador have kind of changed rules to broaden their jurisdiction, that seems like something that you might want to include in the tax treaty, of where might there be overlapping activity. Something's taking place in a U.S. registered spacecraft, but is in whatever area some country is saying you're actually in our area. Now, does it become foreign source, or is that something to avoid the double taxation you want to be addressing in a treaty? Would that be something that, among many things, that maybe treaties going forward need to be considering? What do you think on that?
I believe so. So I would say traditionally the position of the OECD was that with respect to satellite activities and with specific respect to the possibility of satellites to be permanent establishment in another territory, which, for example, in the case for Colombia, if you have a satellite in the geostationary orbit corresponding to Colombia, Colombia might say you have a permanent establishment in my territory. The traditional position of the OECD is that that cannot happen because no country can claim sovereignty in outer space. That was the official position in the commentary to the OECD Model Tax Convention. And it was included in the commentary up until 2008 or 2004. However, I am not sure when they wrote that, I'm not sure they knew about the Bogota Declaration. And I'm not sure Colombia had already included Article 101 in their constitution. So at least that traditional position does not reflect the current state of the Colombian and the Ecuadorian constitution that might generate permanent establishment issues, at least from a domestic tax perspective. So what Colombia and Ecuador might say, I believe that that might need clarification in the context of Article 5. Clearly in the context of Article 7, because business profit can be taxed in the PE state if there is a PE. I believe that Article 8 of the OECD Model Tax Convention should be amended or could be amended to include space transportation income. And so I do believe that there is some work to do with respect to amending tax treaties. Article 21 is then a catch-all clause. So if the other articles of the convention do not apply, then we can fall back on other income. But also in that case, there is a PE issue that might arise. So definitely, especially with respect to new territorial claims, we need to clarify whether those claims can have an effect for tax treaty purposes. There is interesting case law on a different topic, but that does concern PE, the establishment of a PE or the existence of a PE when satellite activities are concerned. And I'm referring to Indian case law, starting from as a satellite onwards. There is also interesting case law in the same sense, but with an opposite outcome. So very similar cases, but opposite outcome with respect to China. And I am pretty sure that there will be even more in the future as soon as we start to looking into what the Colombian and Ecuadorian claims might mean for tax treaty. So thank you, Annette, for
Yes. Yeah, years ago, the OECD started the BEPS project, base erosion profit shifting, was really focused on digital activity and how the sourcing could easily change and it could be, I hate to say the word manipulated, but arguably, I mean, some of the space activity could be that as well, saying, well, I'm in a vessel, maybe I shouldn't use vessel, spacecraft registered in my country. And if other countries are trying to grab some of that, because they are concerned about, well, gee, just register it in some country and then depriving us perhaps of grabbing some of that revenue. So another avenue of looking at, is there any like base erosion profit shifting possibilities here? But yeah, lots to consider here. But as far as the tax incentives, I just want to note that like for the research credit code section 41, it is for research being conducted in the U.S. or its possessions. And there is a reg at 1.41-4 in Title 26. I know we have more than just tax lawyers attending here, but at 1.41-4, I guess it's C7 here, B7, activities outside the United States, Puerto Rico, and other possessions. In general, research conducted outside the United States as defined in section 7701A9, where definitions occur in the Internal Revenue Code. The Commonwealth of Puerto Rico and other possessions of the United States does not constitute qualified research, so wouldn't generate a credit. Section 7701A9 definition's been around a while. United States, when used in a geographical sense, I'm not sure why they put geographical sense in there. Must be some reason for that. Includes only the states and the District of Columbia. And I guess it gets to how much airspace does include in the states on that. Also, I don't think it's anything specific that I've been able to find, but I'm guessing some companies might be saying, "Hey, I have I'm doing this research both in the United States and in a U.S. register that I own spacecraft." I'm guessing they're probably throwing all that into research. There hasn't been a lot of discussion on that, but probably an area where the research credit, which is, had longstanding been a temporary provision for some time now, has been a permanent provision and quite an important one. Bonus depreciation is for property predominantly used in the United States, and that might need clarification if that's not going to be picking up a spacecraft that's spending most of its time outside the United States. And I guess we need to define in maybe one common way, what do we mean outside the United States? When have you left the United States? Just like when have you left gone in the ocean out now to international waters? What is that distance? It doesn't seem from what Erica was saying at the start that it's consistently defined throughout. Also on research and development deductions, that change started with the Tax Cuts and Jobs Act, where we were capitalizing it rather than expensing R&D. And then the OBBA says, hey, we're going to continue to capitalize foreign R&D, meaning research not conducted in the United States. You could only be currently expensing research conducted in the United States. I think that also probably needs some clarification. Would that mean even research being done in outer space, but in a U.S.-owned spacecraft or station, whatever that might be? But areas where there probably still needs some clarification there. And then I note the reference to property tax, because at some point you think, hey, I'm still in a spacecraft registered in the United States, and I want to grab these tax incentives that say, hey, as long as I'm in the United States doing this, I get, for example, research credit, I get to deduct my R&D as opposed to capitalizing it. At what point might states and local governments always desperate for money say, well, gee, we think it's actually not just registered in the United States, it's registered in California. We maybe should see if there's some way that property tax could be assessed on that as well. And states might argue where some of that should be taxed for property tax. And I'm guessing some of it's not subject to property tax any state now, but states always eager to find revenue. Those issues will come up as well. And then you've probably heard about stories about data centers where some of the states and locations are not so eager to have these very large facilities that use a lot of utilities or can be fairly noisy, but talk about, can those go out into outer space? That's going to raise a variety of issues, and perhaps offering some incentives to move these things to outer space. And of course, I guess brings up a variety of other issues outside of the tax law there. But just a few things that just wanted to note. And I did put a link to an article I wrote. Just a quick reminder, you can write, Erica's very deliberate looking at all these new issues and areas to explore into space law. I was just so fascinated by space that when it came to the 50th anniversary of the Apollo moon landing, I thought I ought to get a tax article out of that. And I did. That's actually how Erica and I connected. She saw the article and something in there, and you just never know. So it's an added benefit of not just delving into the space law, but connecting with Erica and her work on that. With that, let me turn it back to Erica and bringing in some state topics with Delinda as well. Thank you.
Absolutely. Thanks so much, Annette. And before I move to state taxation, I just wanted to add something to what Annette has already said. With respect to the R&D tax credit, we are seeing this issue concerning the fact that space research is not conducted within the United States, and a similar issue has been dealt with in Luxembourg. And with the 2020 Luxembourg Space Act, among other provisions that have been amended, Article 152 bis of the Income Tax Act, Luxembourgish Income Tax Act, the R&D tax credit that was originally granted only whenever investments were for research conducted in the territory of Luxembourg and for the development of assets to be used within the territory of Luxembourg, has been extended also to include space companies. So the territorial connection, the territorial element has been eliminated. Maybe this is something we can learn from abroad, from other countries, and we can extend the explicit wording of the provision to include space research as well. So as Annette as mentioned, here we move to state taxation. There are, I would say the environment here is more scattered. Some states have included space-specific tax provisions, space-specific tax incentives, others have not. This is clearly linked to the existence of space activities in the state. I briefly wanted to highlight that Virginia did have a few space-specific tax incentives that were repealed. A report was published where they were analyzing the impact of these tax incentives and realized that there were other elements, so elements other than taxation that impacted more space companies, and therefore these tax incentives did not reach the intended goal and they were repealed. Florida has a number of tax exemptions, for example, for sales and use taxes, exemption from fuel taxes as long as fuel is used for space purposes. And then California is highly interesting for us, but there is an expert here in the room. So I hand over to Delinda for a description of the California state tax provision that targets space activities. So Delinda, the floor is yours.
Thank you, Erica. And thank you everyone for being here this morning. So I'm just going to go over or talk just a little bit about the history behind how California ended up with this regulation that apportions and allocates income derived from space transportation activities. So just as basic background, I just wanted to share that in California here, every business that actively engages in transactions or activities in California for gain or profit, they are subject to tax by California. So beginning in 2013, most taxpayers had to start using an apportionment formula based on sales, which we commonly refer to as market-based apportionment. So not too long after market-based apportionment became the law of the land in California, we received some comments and we had some discussion. So just like Jonathan was talking about earlier today, this is how government works. This is how we hear from others and we hear what needs to be addressed. So in 2015, it was the space transportation industry reaching out and saying that they felt uncertain as to how they should apportion their business income as a result of these new market-based apportionment rules. So generally, a market-based apportionment rule requires that the location of a service for apportionment purposes is to be determined according to where the location of the benefit of the service is received. So when you're thinking about goods or property transported into space, space transportation companies were wanting to determine where the benefit of such service was located. So FTV got together, we had these interested parties meetings in which the public and industry could participate. And really the goal of meeting with taxpayers and meeting with practitioners and with industry was to clarify how income from these space transportation services should be apportioned, and then also just resolve this uncertainty by providing clear and consistent rules for the space transportation companies. Also, just California in general, we've always prided ourselves on being in the front of cutting edge issues. And so the goal of doing this project was really to provide evidence that the state actively engages with industry to address these emerging issues. So like I said, we did some interested parties meetings. And then we also looked at other apportionment principles that we have that apply to other types of transportation companies. For example, in California, we have industry-specific apportionment provisions for trucking, for railroad, for air, and for sea transportation. So as you can see here on the screen, the regulation that we have is found in 25137-15. This is under our 25137 statute, which is our alternative apportionment statute. And just a couple highlights from the regulation. And the first one would be, as Annette mentioned earlier today, we do define space in California. We define space as an altitude of 62 statute miles or more above the surface of the Earth. What's important about that is that to do your apportionment percentage and to do your ratios, you got to work with numbers, right? So subsection C of our regulation, we have some bright line ratios. And the reason we did that was because it was essentially the space transportation industry that came to us and said they wanted these bright line determinations that reflected both the mileage traveled to get to space, so that's where that 62 number comes in, and then also the location of the launch. So these are the two items we use to calculate the ratios that are necessary to determine how much income, if any, from each launch contract should be apportioned to California and thus subject to tax. Our regulation also sets forth some record keeping requirements because, as everyone knows, oftentimes an audit happens years down the road. So it's really important that all your sales and receipts of space transportation activities are kept and maintained by the company. And then the most important subsection, I think, in the regulation is really E, which lays out an example of how to apply the apportionment formula. So I encourage you, if you are looking to, how do I do this ratio? Always go look at the example. It always makes much more sense than just reading the words of the reg itself. So our regulation became effective January 1st, 2016. And I have to say, as I was preparing for today, I went back and I was re-looking at those interested parties meetings that California had with the practitioners and with the industry. And that all occurred in 2015. And at one of those meetings in 2015, the public was asked if there was a need to distinguish between the transportation of cargo and the transportation of people. One of the audience members commented that there are no immediate plans for launching people into space. And that comment, of course, makes me smile now because while I'm sure it was very true in 2015, it would only be a few short years later, in 2021 to be exact, that the very first orbital space launch with only private citizens on it. This was the Inspiration 4. I don't know if anyone remembers that. They went up, it was kind of a fundraiser for St. Jude's. And I believe there were 4 crew members. They were all private citizens. And so, and that only happened 6 years later after the fact. So if you're wondering, yes, we did leave in the language in the reg about transporting people. So even though back in 2015, there was nothing on the horizon that indicated people would be going into space. And we also did not distinguish though between people or cargo. So always room for improvement if we do need to go back and make a change. But I just thought that was so interesting how retrospective it's just such an interesting thing, and how quickly this area is changing, right? I mean, that was 11 years ago that we were in the process of making this regulation. And at the time, there were no plans to send people to space. And now we're talking about it and seeing it in the news all the time. So really fascinating to me. And then you can also see on the slide deck here, California does have a sales tax exemption for gross receipts from the sale, storage, use, or consumption in California. And then we also have the California Competes tax credit, which, as noted, it's not space specific, but it is available to businesses that want to come to California and stay and grow in California. The credit is currently set to sunset in 2030, although I believe there's a bill out there right now that would extend it to 2035. And that credit essentially is a tax agreement credit that's negotiated between our governor's Office of Business and Economic Development. Oftentimes in the media, it's called GoBiz. That's the acronym for that. And they set up these 5-year agreements where businesses commit to yearly milestones for full-time employment, salary levels, project investments. And then once you meet your milestones, then you use the credit. So we're busy here in California. always happy to hear from people, hear what's working, what's not working. Similar to like what Jonathan said, we do not, in California, we don't have any active projects going right now, whether regulation projects, we don't have any active litigation matters on this regulation or topic in general, but like I said, I always enjoy and encourage people to reach out if there's something that you feel, some area that you feel like needs clarity, something that can be, that would work better, because that's what we're here for. So with that, I'm going to go ahead. I'm going to pass it back over to Erica.
Actually, just a comment there. Thanks, Delinda.
Yes.
On the California Competes, it's something where you can identify, hey, this is how much credit I want, and here's what I'm going to do. Like, not leave the state, or I'm going to expand in the state. But I wonder, I don't think it would bring in, yes, I'm going to expand in the state, but some of these people will be working, in outer space, but in my California owned vehicle. But I think it then would say, well, yeah, then we got property tax and other things that we have to deal with that. I think there's a lot of ripple effects as to what you're asking for one benefit might come back and have some other tax consequences there. But yeah. Delinda, are you aware of other states that have copied what California did on this reg? I haven't seen anything, which seems a little puzzling given all the years involved.
I am not. I am not. I do think it is. I mean, if you look, for example, here you see Florida on the slide, Virginia. If you think about where in the country space launches are occurring, I mean, really, it's pretty limited. Texas is not one, notable state that is not on this list is Texas, and or Atlanta, or I'm sorry, not Atlanta. Atlanta is not a state. Georgia. But yes, no, you are correct. There are, as far as to my knowledge, there are no other states out there that have done a regulation or have a law on the books similar to this.
Yeah, and obviously space launch isn't happening in every state, but some kind of activity, still going. And obviously Texas, doesn't have a personal income tax, but it's got some business taxes there that might make it relevant. Yeah, interesting. Thank you. I turn back to Erica.
Texas is interesting, at least from my perspective. The impression that I had from what I read even online was that instead of granting, or at least yet, because I think there is a new proposal, but instead of granting traditionally these broader tax incentives, Texas did grant to specific taxpayers a certain tax exemption from, for example, franchise tax or property taxes. So it was very welcoming to taxpayers working in the space sector, but I had the impression it did use a slightly different technique or a different tactic to attract space companies to the state. And I also, I haven't heard of anything similar to the California regs in other states. So I agree with you on that. So as I promised earlier, the last part of our presentation today, which will be brief, is about the opportunity of using fiscal measures to for space sustainability purposes. And what I'm going to say is not the answer to the space debris accumulation problem. It is one of the potential solutions, or one of the potential tools we can use. I did develop this space debris mitigation fiscal scheme between 2022 and 2023, I would say. Then we published with the OECD in 2024. The broader project was in the economics of space debris mitigation. In the literature, scholars have agreed that the space debris problem is an economic problem, is an incentives problem. And so we were trying to understand whether taxation could play a role. Think about something similar to waste taxes. So what I developed here was not the solution, but was a tool we can use to mitigate the accumulation of space debris in the atmosphere. For those colleagues in the tax field who are not familiar with the space debris problem is a very simple way to describe it is imagine especially the low Earth orbit has been full of little pieces of junk that come from, for example, a defunct satellite or a satellite that stopped functioning or just ended its mission. Generally, the majority of these satellites actually nowadays re-enter the atmosphere and burn down, but some of them stay in orbit, and even a small piece, a very small piece of debris travels at the speed of a bullet. So if it impacts on other active satellites or the space station where there are humans, that can be extremely dangerous. So the OECD launched this project on understanding how we can mitigate the space debris issue. And what I suggested was looking at the use of fiscal measures, not just by imposing a new tax, because that can be highly problematic from not only an economic perspective, as Australia taught us. They tried to kind of introduce twice launch taxes or launch fees, and they did realize that that could create competitiveness issues. So on top of the competitiveness issues and the economic problems that can create, especially for smaller companies, it will not actually solve the issue. So if we only tax at launch, what we are doing is that we are imposing a new economic burden, but we are not actually solving the environmental problem at the core of this whole project. So at least what I suggested was that if we wanted to use tax measures, we should pair the fee or the tax with an incentive mechanism, which can be either a tax credit after the debris removal mission or the successful post-mission disposal, or a kind of a lump sum refund to the taxpayer managed at the domestic level, so that the taxpayer is incentivized to remove the debris in order to get the benefit. And I also at least suggested that the benefit should be higher if if the taxpayer removes debris at an earlier stage, and should decrease over time so that the taxpayer does have the incentive to remove the debris as soon as possible. In terms of level of design, whether this should be international or domestic, what I suggested back in 2023 was that at least the design of these measures should be agreed upon at the international level, perhaps within the United Nations Office of Outer Space Affairs, but then the management of the fee and the credit could be administered at the domestic level, since countries have clearly more visibility, and they are the ones giving the licenses to space companies. So there could also be a connection between the license application and the fee. Right now, this has happened in 2026 with the OBBA new FAA fee. However, that fee is earmarked for FAA purposes. So I'm not sure there will be neither the international level nor the domestic level the desire to introduce a new fee. So take it as a suggestion, maybe for the future. We can think about using our fiscal system, our tax system, for purposes other than just raising revenue, especially for space sustainability purposes. Space sustainability is also crucial for our safety in space. So this is just a suggestion. You can find the chapter in the OECD publication, The Economics of Space Sustainability. There is plenty of literature on this topic. So this is just one of the many contributions, and they are all cited in my chapter. This was the last slide. Thank you all for listening to me for 1 hour.
Erica, on that last one on the space debris, you bring up some great issues of we've got these negative externalities in many sources, including you noted safety issues. But if it's not resolved on an international level, then it's kind of like things we've dealt with in the past about carbon emissions or sulfur dioxide emissions. When you put some strict rule in your country, well, they might just go manufacture in a different country that doesn't have that, but it's still the problem's still there. The space is shared by air, is shared by everybody, but they are difficult. You're right, difficult issues. That'd be an interesting one for international area there. And of course, not everything has to be solved by a tax rule. You could have, restrictions on how much debris you can have out there and trying to minimize all of that.
And I want to
Yeah, you can go to the next slide. We also encourage some questions. We actually have a few questions that have come in. And Erica, that's we did comment on a few of those. So I don't miss it. Does anybody looked at this as space exploration, a term we have used here? Would that be considered advancement of education or science under Section 501c3? My gut reaction is that it would be, as long as other requirements for, meeting nonprofit status are there as well. And that also depends on who's the beneficiary and what the overall intent is. But it seems like this would be science. But again, maybe just another area that needs more definition on it. Let's see other technical questions here. Any additional comments, Jonathan or the Linda? Anything you'd want to add?
On my end, I think you have done a great job of really kind of teeing up a lot of interesting issues, and certainly learned a lot from this. And look forward to noodling over this. So thank you.
Yeah, I learned a lot too.
No additional comments from me. Thank you everyone for attending today. We really appreciate it.
Yes, of course. George, any question from you or comments? Okay. I think it's raised a lot of interesting issues that will, your comment about in 2015, we're thinking about putting people in space, but things do change fairly quickly. And the sooner we address these, but that's one of the comments I made in the article in 2019 was sooner rather than later. I mean, we've seen this, e-commerce emerges, and 5 years later, or maybe it was 3 years later, we put together a commission studying it. Well, then it takes a while for that. This is 2019, I thought it sounded like a good idea. It's even a better idea today. And this comment at the bottom of this slide, George, with the Space Law Committee and hopefully the tax section as well joining in, is maybe we've put the study group together. Let's identify these issues. Erica's done a great job of laying these out, and Delinda and Jonathan as well, and the state and local issues here, but identifying them and thinking about ways that they could be resolved. Where is guidance needed, right? Both we hear from California and federal representatives saying, hey, if there's guidance needed, let's get the comments from you as to where all that should fall. So please contact me. My email is there if you would like to do that. I'm going to make one nerdy point here, maybe all of us interested in space. Not only did I write that article in 2019 about the 50th anniversary, but my husband and I did finally make the trip to the USS Hornet, which was the recovery ship for the Apollo 11 folks, which is permanently docked in the Bay Area there. And on the way there, of course, we had our 1969 music play going on as well, really getting in the moment here. But I know there's many people really interested in just space activity and then various legal issues it raises here, focusing on tax matters here. But a big thank you to Erica for putting all these slides together, all your continued work in this area, really raising these very important issues, I think, in a very timely manner. And hopefully those of you will take advantage of looking at this space study commission that the ABA can start working on, or if you got friends or colleagues that might be interested, please let them know as well. And I see you're going to be getting a copy of the slides and a link to the recording here. And with that, George, if you got a final comment, otherwise I want to thank everybody for attending, and thank you to our speakers.
Well, thank you everyone for your attendance in this fascinating webinar. And please If you have an interest, please join the study group that the ABA that we're working on, perhaps in conjunction with the tax law section. Thank you very much for your attendance.
Right. Thanks, everybody.